Welcome to Remarkable Retail Podcast, episode 304. I'm Michael LeBlanc.
And I'm Steve Dennis.
A quick reminder, the Remarkable Retail Podcast is the official podcast of the Commerce Next Growth Show coming up 1 week from today in New York City. We'll be grabbing lots of content that will be included in our summer episodes. Steve, looking forward to seeing you in person, my friend.
It should be fun. And I also think we're going to see at least one of our guests on stage. We'll maybe save that for later, but one of our guests today is interviewing a young up-and-coming retailer named Mickey Drexler, I believe. But we can straighten that out in a few minutes. But yes, looking forward to seeing you.
On this episode, we are back with our very popular analysts to hash over the latest and greatest topics in retail right now. And speaking of the greatest, we have assembled the greatest brain trust in modern retail history with Sucharita Kodali, Vice President and Principal Analyst from Forrester, joining us from North Carolina. Simeon Siegel, Senior Managing Director, Senior Analyst, Retail and E-commerce, Guggenheim Partners, joining us from New York City. And Neil Saunders, joining us from Parts Unknown, a.k.a. Phoenix, for our rousing roundtable discussion. Now, speaking of the summer, we're trying something different this year. We will have live episodes every 2 weeks that will also feature interviews from Commerce Next. So we'll be skipping next week, and we'll be back on June 30th. And we're moving along so fast, we haven't even had the analysts say hello yet. Simeon, Sucharita, Neil, how you doing?
You didn't give us a chance. You just kind of like, you were doing so well, we didn't want to interrupt.
Well,
hello, everyone.
Hello, everyone.
Hello. Fantastic.
Right. And Simeon, it is true, right, that you will be interviewing Mickey Drexler on stage.
I am fortunate enough to be doing not my first, but yes, I will have a very fun conversation with Mickey. It is always a privilege to sit down with Mickey.
Why don't we jump in? I thought maybe we would start kind of big picture because we have just wrapped up earnings season. And of course, there's always a ton of macroeconomic data, a ton of consumer data. But I'd just be curious as we look back on the year so far and the quarter that was, we've got, for the most part, I think pretty good retail results, a few exceptions. Most retailers sounding a bit of caution. But these good results all come up against consumer sentiment, which is pretty awful. So, Simeon, we'll start with you. Can you help us make any sense of what's going on?
So making sense versus saying what's actually happening feels like two totally different things these days. But I think, and we've talked about this in different versions before, I think just consumer sentiment versus consumer spending are increasingly a tenuous relationship at best. I think when people talk, it's different than when people spend. And I think what's really, really, really important is we hear about all these negative backdrops. We know them, whether it's versions of the K-shaped economy, which I'm sure we'll talk about, whether it's global, whether it's really just all the dark clouds that have been here. And yet, best retail sales from a company level I've seen on the discretionary side in forever. Starting Q3 of last year, they just keep getting better and better. And so I think a lot has to do with tariffs. I think a lot has to do with price. And we'll get into this conversation, but I'll pass the baton from here. But I think what I'm looking for, really first and foremost, who's driving more people into the box, into the business versus who's just getting better price. I think everyone got higher price from AUR because of tariffs. I don't think everyone got new customers.
Neil, what's your 2 cents on this?
Yeah, I really agree with Simeon. I think there is this disconnect between sentiment and the reality for consumers. And, we survey every single month people about their sentiment around the economy, and it has increased in terms of the number of people who say that they think the economy is going to get worse. But the interesting is we can also track their actual spending, not what they say they spend. And among all of those who say that they think things will get worse, about 60% went out and spent more than they did in the previous year. So they're not really reflecting in their spending what the underlying mentality is in terms of where they think the economy is going. And I think, honestly, it's because there's just so much uncertainty. The policies change on the hoof, the economics, there's the war with Iran. There's so much going on, and people are uncertain, and that leads to negativity. But when it comes to spending, I think they look at their finances and the reality. And of course, in March and April, to a certain extent, we had tax refunds in the US, which were more generous than last year. And I think that has offset some of the uncertainty. But the interesting thing is, where does it go from here? Because obviously that benefit, that shot in the arm from tax refunds, it isn't going to repeat itself across the remainder of this year. So I think it's going to be very interesting to see where we head.
Are you able from your data to see, because, a lot of people have quoted just in general that something like the top 10% of earners account for more than 50% of spending. So there's part of me that says, well, inflation and all these other concerns don't necessarily affect the people with a high discretionary income. The stock market's doing well. And, maybe some of this is skewed and masks that, it is kind of the K-shaped thing. Are you able to tell whether that's part of the explanation here?
Yeah, we do look at the income cohorts, and it's definitely true that the higher income cohorts and households are driving most of the growth. But actually what's interesting is it's more true in volumes than it is in values. I think in values, the middle income consumer is also driving growth, not because they want to, but because prices are so much higher. The lower income cohort in value terms is down slightly, but it's fairly static. But when you look at volumes and you strip out inflation, almost all of the growth is being driven by that higher income household cohort. There's a little bit from some middle income consumers, but it's not as much. So there definitely is that pattern there of the growth being driven by the more affluent, because they're basically the ones that can go out and afford the increases in inflation and still afford to buy more on top of that as well.
I do think what's interesting is every piece of data seems to very much go along with what Neil was saying. And I think we all keep that's where the K-shaped economy comes from. But what's interesting on the micro level, if I were to look back and say, okay, who did well this past quarter? Ross Stores put up a 17% same-store sales gain. Victoria's Secret grew 15%. And so and they called out both, it's interesting to Neil's point, they called out the bottom and the top, and the middle was maybe the part that was a little bit more lacking. But you are seeing businesses across every subsegment generate revenues. And it does seem, obviously, Ross probably gets some trade down, but to do a 17 comp, you also have to do well with your existing core. And so that's where I think it is. We are seeing businesses across all sides drive revenues.
Mm-hmm. Yeah, let me come back to that, but let me bring Sucharita in. I'm curious, Sucharita, what you're seeing from your perspective.
I think that it's a lot of the same narrative that we've been talking about. It's throwing some buzzwords out there. I mean, we've been talking about peak ambiguity and the vibe session for a long time, and it doesn't seem like anything has changed either of those situations. We continue to be more uncertain than ever. We have more geopolitical conflict in the world than ever. We have more uncertainty around AI than ever. We have more uncertainty around what's going to happen with interest rates than ever. So those are all factors that adversely impact every part of retail, from supply chain to operations to investments to consumer sentiment and spending. And as far as the vibe session goes, that's really the bottom of the K, where you have a lot of people who may be told that, kind of, hey, there's nothing to see here with respect to the economy, kind of looking at their bank account and being like, I don't feel quite as confident in what I can afford, and I'm not sure if things are going to be as secure for me, kind of in the next few years, much less the rest of this year. And I think that those are the people that are trading down to Dollar General and Ross and, kind of Walmart and, the other players that are the value players. We've been buoyed in a lot of ways by those upper income households. Kind of just a nuance to Simeon's point about retail being at the highest level ever. It is at the highest level ever, but it's almost like not exceeding inflation. It's because inflation is really high and everybody's just passing on inflation costs to consumers. And let's remember, that's part of, kind of the negative consumer sentiment too, is that when you go back to 2019 and you're looking at everything from eggs to gas prices back then and looking at things now, kind of people always anchor themselves on the good old days of how cheap things used to be. And when things are, double what they were, or you remember, kind of the best it could be, that does not give anybody confidence that, kind of because their income, nobody's seeing their incomes grow that quickly. That's for sure.
Yeah, right. So one other just quick follow-up. I've really noticed, not only with some of the retailers like Ross, like Victoria's Secret, but just in general, some of the data we get from the NRF, the Census Bureau, that apparel sales have been really strong for some time here. And I think one piece of speculation here, or I think there's some data, is that the rise in GLP-1 is causing a lot of extra apparel. So I wonder to what degree is that, apparel is a big sector. Even the beauty sector has been pretty strong. And some people have said, well, when you lose a size or two, maybe you spend a little bit more money on fashion or to make yourself look better. You're feeling more confident. Any sense that is kind of a disproportionate driver of sales? And I guess, as GLP-1 growth, to the extent it is, as GLP growth becomes more widespread, that would seem to be a thing that could continue for some time, if not for years. Anybody have any data or any thoughts on that?
Well, the irony is that even though that may be true, or the GLP-1 growth may be true, you're seeing certain brands that would seemingly be beneficiaries of it, like Lululemon being at kind of they've given up all their gains since the pandemic, at least as far as their stock price is concerned. Nike is in a similar boat. And, so it's curious, who are the winners in this?
Yeah, we do look at, we have done some studies on people who are on GLP-1s and their consumption habits. It's a very small study, so you can take the results with a pinch of salt, but there definitely is higher levels of spending from those on GLP-1s on clothing. And some of it is closet or wardrobe replacement. So obviously you go down in size, you need to buy new clothing. But the other thing that's interesting is there's greater levels of confidence come through as people lose weight. So they actually change up the type of things that they buy. They change styles slightly. They invest more in clothing and apparel because it's part of their new look and the new feeling that they've got. So it is interesting. I'm not sure how big an impact it is overall, because obviously there are quite a number of people on GLP-1s, but there are a significant number that aren't. But I think with apparel, you've got other things in the mix. There's definitely inflation in there. Prices have gone up by quite a lot. I also think people are trading up to some degree. I think they're trading away from kind of casual, basic apparel. When they're investing, often they're trying to invest more in statement pieces because they last longer. And actually, that's what they really want to spend their money on. Whereas the basic bits, if you dissect it, are not growing by quite as much. So there's definitely some interesting dynamics that are kind of driving apparel. But again, how long does this last? I think that's the question going forward, because obviously you're going to start lapping the inflation from the prior year as you get into the second half of this year.
Yeah.
Consumers may have less to spend because of lower tax, refunds, etc., or that petering out. So I think there are question marks as to how long this lasts for.
The GLP-1 is a very interesting potential reason as to why. But I think what's really important is the fact that it's happening. And so the spending is happening. And if we're all the macro fears, everything we're talking about, it shouldn't matter. GLP-1 shouldn't matter. It shouldn't be, okay, you know what, I'm feeling like I want to change that. You should still be forced to figure out how to make do with more if people aren't spending. I think it's important we just keep acknowledging people are spending when it comes to this discretionary category.
Yeah, it's all great points. Now let's shift gears a little bit. Last week on the show, we talked about the state of a few turnarounds that seem to have some real momentum. Victoria's Secret, Simeon, you called out their outsized performance, the Gap brand. But we did save talking about Nike and Lululemon with you, our panel of experts. So what's your take on where they each are and need to be? Simeon, you want to kick us off? You've generally struck over the course of our conversations a positive or at least a bigger picture perspective to the state of these brands. How are you feeling about Lululemon as a new CEO and seems to have resolved their conflicts? How are you feeling about them and Nike?
Yeah, so hopefully this doesn't come as too much of a surprise. And Sucharita mentioned Lulu's given up all of their gains from COVID vis-a-vis the stock. And I think she threw in the stock point very much on purpose because the revenues have not, right? So this is the company, the market cap giving up. The revenues have just started to tip. And so we've all talked about this a lot. My team's done a lot of work on where brands peak. $3 to $4 billion in the US is where brands ubiquitize. They peak higher and come back down. Lulu is too big. It's a great brand. It has the ability to be a great brand. I just think it's too big. And I've worried it's been too big for a while. And so now I think we're seeing it. And so I actually think Heidi has a difficult task ahead of her, nothing to do with her. I think the reality is what we're seeing Nike is showing us more than anyone. It takes a long time to reset a very large and overextended brand. Ralph took many years. Coach took many years. And those are the successful ones. And so I think right now what Lulu needs to do is it's both overselling, it's too big, it's also over-earning, it's very, very profitable. And now it's finally starting to see that come down. And I think the biggest point that we have to remember is there's a view that Alo and Viore have stolen so much share from Lulu, and yet Lulu's revenues just downticked now, which means while giving up all the good sales, they flooded the bucket with bad sales. And so to fix the brand, you have a lot of bad sales that need to walk out the door before we can re-elevate.
Sucharita, what do you think of this argument? Is basically that gravity affects everybody at one point time or another?
Yeah, I mean, what I'm hearing in Simeon's point is that they have probably over promoted and over distributed, and kind of not being true to the core that made them what they are. Correct me if I'm wrong, Simeon.
Preach.
Yeah. And so, I mean, it's fascinating. You're talking to Mickey Drexler in a few days because this was exactly the journey of Gap, right? And, kind of, so what do you do is maybe they need a low end line to, kind of inject growth, or they need to, buy, I don't know, some, kind of lower end, kind of fitness player, or launch a new version. Because it seems like that's really the journey they need to do, is be true to the premium Lululemon. They probably even have an opportunity to even go, kind of upmarket to a very small segment of consumers. And then there is the masses that they can also distribute to. The question, though, is it a day late and a dollar short? Because everybody sells their products, the similar products. And, kind of you can usually find $10 to $20 leggings everywhere, including at Dick's Sporting Goods these days. So I don't know if, kind of they'll have how much success they will have, but they have, they certainly have the ability to do so and to take a page from that Gap playbook if they choose to do so.
And to your point, Old Navy's now 2 to 3 times Gap size.
Exactly. That's the thing, is like the market opportunity is really what is, the big promising opportunity, kind of whether or not they'll have, well, these days with retail being so much e-com, it kind of the physical stores probably aren't going to matter quite as much. But the bigger question is they're stepping into a highly saturated market. The time to have done this would probably have been, a few years ago.
So Neil, let's talk about another turnaround. I know you and I seem to be a little bit of a disagreement here. You become, I think, quite positive about the Macy's turnaround, and I think for sure Bloomingdale's is pretty impressive. But when it comes to Macy's Inc., I just want to try to understand a little bit better why you're, I guess, more positive about it. Their percentages, we just talked about how strong the apparel category is. I mean, they're performing way under, and even some of their their reimagined stores, the difference between those stores and the rest aren't that significant. And, presumably they picked those stores because they had greater potential, and they're closing stores here in Dallas. The store they closed, I'm sure the sales are migrating to 2 reimagined stores. So I'm just trying to understand, when you look at the metrics, they're clearly better, but what gives you the confidence that they're really on the right path?
Well, I agree with you. I mean, this is not a complete recovery. They're not at the stage where you would say this is a fantastic retailer that's gaining share. But I think you have to be fair. I mean, you and I have spent years criticizing the lack of attention to basics in the store, the fact that they didn't have a grip with what was going on with the customer, the fact they weren't investing in things like private labels. And Tony Spring has come in and he has changed some of that. I mean, there's a lot more to do, but you have to sweep from the top step. You can't start doing all the fancy stuff when the basics are still broken. And I see in the metrics, things have got better. We can all see that. But there's lots of other metrics that underpin that we track, things like customer satisfaction, the visitation levels that have improved in tandem. And I think it shows that they are starting to get on the right track. You also walk into the shop floor and it is light years away from where it was 5 years ago. Yes, it's not going to produce results overnight, but I think you have to give credit for that and the investment that's going in. And the fact that they've just stopped the decline and they've started to turn the ship, I think is worthy of credit. But to your point, there's a lot more to do. You have to fix the basics. Then you have to think about how you go beyond that. I think they're starting to have plans for that, especially in the development of some of their own private label things. But I think from a very, very difficult position in a business, a legacy part of the market, department stores that's still difficult, I think Tony has done a very good job. And don't forget, so many people that came before Tony did not do that good job. So he's having to undo years and years of neglect. And I think that at least deserves some respect and encouragement, even if the numbers aren't quite up to par, which they're not, arguably. But it's how you get them to be up to par over the next 5 to 10 years. And I think they do have a chance now, whereas 5 years ago, they could have been on the trajectory of Sears.
Yeah, I would agree with that.
Sucharita, let's turn our minds to your thoughts, so to speak, and is the bloom coming off the rose, so to speak, on Gen AI, and agentic commerce will deliver as profoundly as many think? I talked to retailers yesterday; they were still quite optimistic about it at the operational level, though some are saying, boy, we're using up a lot of these tokens and it's starting to add up. And then what are you thinking about? Where's your level of positivity or negativity on the scale?
I'm always a contrarian. I think that, yes, right now, things seem to be particularly down on AI. There are all the media stories about consumer sentiment against it, which I think are justified. But I also think that some of these corrections in the stock price with that, kind of like the SaaS apocalypse and, kind of this sense that the generative AI tools and the agentic tools are all knowing and are going to take everything away. I think some of that is a little bit overstated. But my thesis has always been that AI is much more than generative functions. AI is machine learning, it's deep learning, it's robotics. There are a lot of applications which have been incredibly valuable for decades already and only continue to be incredibly valuable and will continue to support the growth of companies that embrace the right technologies to automate and improve efficiencies in their business. So I'm not bearish on it, but kind of what I see all the time is people piling on to, shiny objects and, then getting disappointed when those shiny objects don't necessarily deliver. And a lot of these shiny objects are not addressing core business problems. However, I do think that there are many software solutions out there that, continue to address great problems, big problems, and do so successfully.
So speaking of shiny objects, Simeon, you and I have talked a lot, and you've shared a lot about direct to consumer. It seems like the digitally native vertical brands, for the most part, have not performed particularly well. But I just want to get kind of your updated thoughts on your, I guess it's several years old now, study about DTC not being all it's cracked up to be. What's kind of your latest and greatest thinking? Because the DNVB part of it and the Allbirds and all that kind of stuff has obviously collapsed. Nike's had its trouble with its DTC strategy. But at the same time, you are seeing a lot of manufacturer brands on Levi's, Viore, et cetera, driving a lot of their growth and seemingly their profitability through their DTC strategy. So what's kind of the latest and greatest, Simeon, thoughts on this?
So first of all, Steve, you can always call me your shiniest object. It always works. So
define works, by the way. Define
maybe a little pancake makeup would,
Anyway, so I think the beauty is we had this magical world called omnichannel, and when omnichannel was used right, it was probably the perfect word, right? I hate buzzwords. That was probably the one buzzword that made sense. The problem is omnichannel became internet very quickly, and so we forgot that it meant everything. But that's the story, right? The title of that note was D2C is not all it's cracked up to be, and I became the anti-D2C guy. But the point is, it was less anti-D2C, it was more anti-wholesale. And so you mentioned Fiore. Fiore has a beautiful D2C business, but under Joe's leadership, like Joe appreciated, he also, so Fiore, the CEO of Fiore, also appreciated that they should have a beautiful wholesale business. And so it's the idea that there's both. And I think that's what's key. And I think that we went so back and forth. We watched that pendulum swing so severe. Nike is the best example of D2C or bust to bust, right? And then realizing we had to re-embrace wholesale. But even as they re-embrace wholesale, I don't know if we've talked about Birkenstock, but there's a bunch of these businesses which actually are putting up really good revenue growth, but they have wholesale growing faster than direct. And you would think at this point we would be okay with that, but we're not. And so the world still is allergic to wholesale. They believe wholesale is less healthy. They believe wholesale is stuffing the channel. Wholesale is, to Neil's point, Macy's still has over $20 billion of revenue. That means consumers are spending $20 billion through them. And so when done right, wholesale is the best way to drive your business. When done wrong, wholesale is the worst way to drive your business. And so it's all company specific. But what I would say is what we have kind of like the incremental learning from that very first report is if you're a luxury business, if you have incredibly high gross margins, that's the one exception where D2C is very much all it's cracked up to be. Because what you don't want to do,
a luxury
you don't want to
in
share.
particular. Yeah.
Correct. And so outside of the luxury sphere, I would still very, very much recommend all businesses entertain some version of wholesale. They just need to figure out who the right partner is, when and where to do it.
Maybe one quick follow-up on that, because I wonder the degree to which people got faked out, Nike in particular, but others, by this great e-commerce acceleration. Because when that growth occurred so quickly, because I even know, having worked with Nike, they very much thought about their own stores as a big part of direct to consumer. But then it was kind of like, oh, well, why don't we just do all our business online and everything will be great. And then, of course, that pulled back massively in 2022, 2023. So I think some of this was also, it wasn't even so much their own stores. It was, let's just go direct through e-commerce because we thought that was going to go to the moon. And then it just reverted more or less to the path it was on. And that got a lot of people off kilter, I think.
Well, as Sucharita likes to say, you can't spell contrarian without AI. And so when you think about retail, you and I have talked about this idea that everyone got so sucked into the notion of D2C equals digitally native, but that's two different things. D2C is against wholesale. It's not digital. And so this idea, like you and I talked about this years and years ago, if you had the choice of driving $1 of revenue, the absolute best place to do it, if you could choose, is your store. Because in your store, if you have a store, the customer is your employee. All these extra spending that we have of logistics, fulfillment, that's a customer walking over to a you stack and rack your inventory once, customer walks over, takes it out, walks it to the cash wrap, walks it out the door. They just fulfilled it. They just paid for it. They just shipped it, right? All those would have cost you money in a different vehicle. And that's completely ignoring the benefit of actually having control of the visual. And so stores are great. And thankfully, Gen Z or Alpha or whatever we're up to are realizing stores are great. Doesn't mean you can't do e-com, doesn't mean you can't do other things. It means you should do it all. But yeah, this idea of like, we're allergic to stores, let's just do everything online and let's give free shipping forever and free returns forever. Thankfully, that's been dialed back.
Neil, channeling retail geek Jason Goldberg, who points out on average to bet is flat when thinking about averages. So much of the incremental growth that is happening in retail that we see is happening with a few players. Amazon, Walmart, Costco, the off-price players. What do you see as the drivers behind the obvious? I mean, we've talked about a bunch of things already so far that can sustain that kind of comp store growth for these players, particularly off-price, but not singularly. What do you think's the sauce there, and do you think they can continue growing?
Yeah, I mean, I think there's some obvious things. You know, if you're looking at Walmart, for example, or Amazon, they both have very big essentials businesses and people will migrate to them for all sorts of different things. So they capture a wide audience and that doesn't really change whether times are good or bad. But I think beyond that, there are things that they do. The first one, and Amazon has done this for years, and Walmart has caught up over recent years, is they have incremental businesses. So they have marketplace revenue, they have advertising revenue, they have in-store media revenue now. And those things aren't as big as the retail businesses, but they are considerably helpful, especially for Amazon. And they're very helpful for margins as well. And because of the scale, they are able to add those bells and whistles to the core business, and it creates that flywheel. But the other thing I think that a retailer like Walmart has done is it has maintained the core. So all the people that used to shop at Walmart still shop at Walmart. It's maintained the promise of everyday low price. It still captures those people. But it has captured a lot more people in addition to that, especially from higher income consumers, because people say, hey, buying laundry detergent, it's not particularly fun. It's not particularly interesting. I don't want to spend over the odds on it. And Walmart is a few cents cheaper, and added up across the course of a year, I can save a lot from going to Walmart. So really, Walmart has enlarged its share of customers. And Amazon has done the same, I think for slightly different reasons, because Amazon has expanded out fast delivery to more rural areas. So again, it's widened the customer base. And I think that's the trick. You generate the great revenue because the core remains pretty stable and grows a bit. But then you've got the icing on the cake of the new customers that you attract, some of those flywheel things as well. And I think that's one of the tricks that those retailers have used. The thing is, not everyone can do it because not everyone has that scale or the relevance or the reach. But for those guys that can, it's useful.
Sucharita, is there anything that can stop the stampede of value that we're seeing going to the value players in that equation?
Well, government stimulus. That's certainly something that we saw work incredibly powerfully in 2020. But I don't see something of that magnitude ever happening again. And the truth is that the demand curve in kind of the economy is downward sloping, and people always purchase more if prices are lower. So the bigger issue is anything going to stop the commodification of goods, where you basically if you have enough distribution, there's always going to be somebody who's going to essentially price things at cost, and that I think is where value comes in, and that's where people will trade to. Kind of the bigger question, I think, is how do you differentiate, kind of and create things that people want that are unique, and then how do you market that in this day and age where it is increasingly more difficult to break through all of the marketing clutter that is out there, and now all of the fake information that kind of LLMs are hallucinating.
Yeah. Hey, Simeon, I want to ask you, we know we're not an investment podcast here and not looking for investment advice, but one of the things that occurs to me, particularly...
You guys asked me about SpaceX? Is that where we're going?
No, I'm
Rivian.
trying to get
I want Rivian information.
My put orders in. But, one of the things that when I was at Neiman Marcus, we paid a lot of attention to with the high-end customer was how they were feeling, not just about their discretionary income, but their overall wealth. So when real estate values are going up, stock values are going up, big bonuses are paid on Wall Street, these kinds of things seem to be pretty well correlated with how the high-end consumer did. Now, obviously, we've had an incredible stock market for several years now, but a lot of that has been driven, as you well know, by relatively few players. And we've quoted Scott Galloway a few times about basically saying that the market is just one big bet on AI. So not only are we seeing all the construction spending and all that kind of stuff, but just, a few of these really big players, and now SpaceX, I guess we have a Mag 8 now, but how much, from a retail perspective, how much risk do you think there might be to the retail market, and I guess to some of the higher end names in particular, if we were to see a major correction in the stock market?
Yeah, it's a really interesting question. It's probably way above my pay grade. I mean, literally, I think we now are watching the creation of the first $1 trillion man, right? And so we're talking about, we started this with inflation on milk. We've watched inflation on market caps as well. Like, it's not hard for us all to remember that first day when we got our first $1 trillion company, and now we've got a handful of them, more than that, and they're just $1 trillion is not cool anymore, right? I mean, like that's small, and so
$1 trillion here, $1 trillion there. Pretty soon, you're talking about real money.
Exactly. And so I think that what's interesting is I still traffic in companies where if they add $1 billion to their market cap, that's a pretty meaningful move. And so it's this funny dichotomy where we are watching, to your point, this one world where the S&P is being brought up by these $1 trillion businesses. But we're still talking about, like, people still buying Gap sweaters and talking about Victoria's Secret lingerie and all these different pieces, which is just a different scale. And so that's why what I try to do for my job is really, going back to the GLP-1 question, is just isolate, okay, what are the why, what are the drivers, but what's the reality? Because what we need to do is not create a reality that doesn't exist. That's the consumer sentiment versus consumer spending dynamic of if we were just to rely on the why and the consumer sentiment this whole time, all these businesses are actually dramatically worse than they are really doing. And so what I look at is, you're right. Do I think that is the reason? Is everyone looking at their Fidelity account and saying, you know what? Thankfully, my random advisor put me into the latest IPO and now I can go buy more. I don't know. Maybe, right? I mean, there is definitely a wealth effect, and that historically has been relevant for the luxury side, and maybe more people have access back from COVID days when everyone got involved from the retail investor, not retail industry side. But I do think it has to be more than that, because I don't think people are actually selling a share of every stock to go buy these sweaters.
Yeah.
And so it goes back to sentiment versus the actual spending. And so if the market were to collapse for a sustained period, should that have an impact? Certainly. But is that the driver? Is that the motivation for really what's been pushing this kind of surprising level of retail spend? It's probably a factor. I don't think it's the primary driver.
It's sort of interesting to me, because I was looking at the consumer sentiment by different income levels. And yes, it's true that the higher income folks, their consumer sentiment is higher, but it's also been on the decline, and I believe historically low. So you would kind of think, well, if my value of my house is going up, my stock portfolio is going crazy, I'd be feeling pretty good, but it doesn't seem to be the case. So we really do seem to be either living in a simulation or some sort of alternative universe.
I will say, I talked to professional institutional investors all day long. That's my day job. And these are people that are supposed to look at the market and find the good from the bad and find the opportunities. There's very few people that feel convicted in something to own. Like it's like celebrities, they're just like us. Like institutional investors, they're just like us. The market's hard, right? Right now, when things are where they are, it's hard to find the underappreciated. Things are expensive for a reason and things are cheap for a reason. And so to your point, the people that are the highest income that generally are trafficking in this for a profession, perhaps, they're not feeling better about it. Like, they have more money, but it's not there's a cognitive dissonance about should this be here versus, okay, I'm just going to buy more and chase it.
All right. Well, what a great discussion. Let's wrap with some hot takes or quick bites or whatever we want to call it on commentary for a couple of questions. And I'm going to go Neil, Simeon, and then Sucharita, you're going to get the last words for the show. So first question, what's an exciting brand to watch that doesn't get enough attention and why? So Neil, Simeon, Sucharita.
Well, I'm going to please you because I'm interested in Cozy, which obviously is a Canadian retailer. It's not a big retailer. It is coming to Chicago, and it's opened. I think it opened a pop-up in LA, and I'm interested to see how it performs because it's a bit like a sort of posher version of IKEA. And obviously the furnishings market's kind of difficult, so I'm interested in seeing where that goes.
All right, Simeon?
Normally we go small with this. I'm going to do the opposite. I have for years been telling you TJX has been my favorite business. Ross stores. So flip. So now my team did some nice work, really good work. So thank you to the team. I think we found what made TJ so special. We could do our own podcast of this next time. It started in 2018, 5 steps. I think Ross is doing them. Keep an eye on Ross stores.
Sucharita.
When did Goyard bags start becoming like the thing that everybody had all of a sudden? Kind of this was something that I'm like, oh my gosh, how did I don't even think I knew about the brand like 36 months ago. It's like,
that's
I think
because you never worked at Neiman Marcus. That's
I know, Steve. I worked at Saks, and even at Saks, I don't think that, kind of it was like the thing. So I'm curious whether this is going to be a flash in the pan. It shouldn't be a flash in the pan because they're at the price point, and they don't really discount. So, kind of is that the next, kind of luxury brand to take over America?
All right, Neil, what trend or piece of news is on your radar screen for the weeks and months ahead? What's captured your interest?
Well, it's a very boring one, but it's an important one, and it's inflation, because the latest numbers are not looking good. And of course, we've still got the impact of tariffs to a certain extent, but now we're starting to see the impact of the surging oil price come through. And it's going to be very interesting as to where that goes and the impact it has on consumption, because it may push the numbers up, but it probably ain't so good for volumes. So looking at that.
Right.
So for the next couple weeks, I'm going to steal Oliver at Birkenstock. This is his line. For the next couple weeks, the news I'm looking for is the middle of the donut. I am so excited to look for nothing. Earnings are just done. The next couple of weeks are going to be a retreat. They're going to be a focus on actually doing work. And we're going to pretend like there's no news happening for the next couple of weeks as we gear up for the big Mickey closing.
All right. Very zen of you, Simeon. Sucharita, bring us home. Take us home.
Well, we are in an election year, and it's in the United States, and it's a pretty important one. And I think that what ends up happening over the next few weeks, even in primaries and with geopolitics, is going to shape the outlook for the economy and ultimately for retail. So, yeah, we shall see. I think that a lot of people are looking for stability, not more chaos. So I think we're grasping for any signals of stability.
Well, Neil, Simeon, and Sucharita, what a pleasure to have you on the mic again for our very popular Analysts episode. That's a wrap. Thank you all for donating your time, insights, and your generous humor and thoughts to our podcast. Let's leave it there.
Thank you.
All right.
Thanks, guys.
Thanks for listening. To learn more about my keynote speaking, best-selling books, and advisory services, go to stephenpdennis.com. And don't forget to check out my Substack, Pardon the Disruption.
Be sure and follow us on your favorite podcast platform or on YouTube and give us a 5-star rating and review. This summer, new episodes will be released every 2 weeks. You can learn more about me or get in touch on LinkedIn or online at emmyleblanc.co.